You're listening to Macro Sunday, hosted by Andreas Steno. Welcome to Macro Sunday. My name is Andreas Steno. I'm the founder and CEO of Steno Research, and this is your weekly independent macro podcast with hot takes on everything from geopolitics to macro strategy. This week, we're going to talk about coups, peace talks, steeper interest rate curves, and the marvelous Bank of Japan. And remember, as a broad disclaimer before we get going here, that our trade ideas may be...
Sometimes may be good, sometimes may be shit.
You gotta love Gennaro Gattuso. We've had a lot of questions on who's saying this, and it's the former AC Milan midfielder, Gennaro Gattuso. You're better at pronouncing this, Mikkel.
I think that was quite spot on, I think.
Welcome to the show, Mikkel Rosenvold.
Thanks a lot.
Head of geopolitics here at Steno Research, and we also have Emil Møller, head of research here at Steno Research with us. Good to see you, Emil.
Yeah, cheers. Likewise.
Guys, it's been a completely bizarre week in many ways, both in geopolitics and in macroeconomics. And I guess we have a lot of things to discuss, also in relation to how markets have digested all of these events. But I'd like to start with the marvelous Bank of Japan. We released a special podcast on the topic of Bank of Japan a week ago, after the decision to sort of move the needle on the yield curve control in Japan to now 1% in the 10-year point of the Japanese government bond curve. But we've had quite some back and forth price action in Japanese markets over the past week here, Emil, and the Bank of Japan very involved in the trading, so to speak. So what do you make of Japanese markets at this juncture, now that we have sort of a week of empirical evidence of this new regime?
Yeah, still early days. Let's start there, but it's been volatile, to say the least. And I think what sort of is my takeaway here is you are not on the safe side in case you go short in Japanese government bonds, because the Bank of Japan will intervene, and it will take time before markets will be capable of pushing on the 1% yield level. That's sort of my main takeaway. That means that we will probably see a gradual tightening of financial conditions in Japan, and that might be a bit of a problem if inflationary pressures in Japan keeps at the level that they are currently. So that's a bit of something to watch. We might have to see more tightening of monetary conditions in case things go a bit beyond what they expected. So yeah,
we obviously have a relatively new governor of the Bank of Japan.
Yeah.
Kazuo Ueda, something like that, and he's an academic. He spent plus 20 years at the Tokyo University. Yeah. But when he visited Sintra in Portugal, just 3-4 weeks back, attending the ECB yearly conference in Portugal, he actually surprised by being a truly funny guy. So let's listen to a soundbite from Sintra with Kazuo Ueda.
We'll see. We haven't had any serious monetary tightening for 3 decades. So in terms of that, the lag in the effects of monetary policy could be at least 25 years.
This is just an amazing comment from Ueda here, referring to they had a panel discussion on how monetary policy sort of impacts the real economy with time lags. And he sort of made the joke that the time lag may be as long as 25 or 30 years in Japan, right? Yeah. So the question here, Emil, is now that we see, let's call it the very, very first signs of normalization of the Bank of Japan policy, do you think there is a time lag from this decision last week until we actually see the effects on the Japanese economy here?
The thing is, the Japanese economy is so unique. And we are definitely in uncharted territory here. We don't have any historical precedent for it really to rely on.
No.
So my takeaway is more that I think they were really clever in keeping their new regime flexible, and I think they're quite humble about where they are. But still, I think. I mean, if energy and commodities keep pushing up, now we've seen a bit of retracement. But if that really starts to gather steam, I think there will be. I think they will perhaps need to do more, or at least step up on the rhetoric. So that's sort of the fence I'm on right now, and I think that's where they are as well.
Yeah, I released an article last week on the flow seen in the Japanese yen and in the JGB market post this decision taken by Bank of Japan.
Yeah.
And I think it's really interesting that you can actually get the cocktail of a weaker Japanese yen and a steeper yield curve in Japan with slightly higher 10-year bond yields at the same time. And I think it requires a bit of explanation since it is sort of an odd cocktail. So if we look at the flows right now, it is relatively clear to me that the foreign fixed income market is sort of closed territory for most Japanese life and pension funds. As a consequence of inverted curves in the US and in Europe, paired with a steeper curve in Japan now. I've traveled Japan and Asia several times selling fixed income products, mainly from Scandinavia. And they have a very, very strict fixed income mandate, meaning that they have to hedge, say, 10 or 30-year bonds with either a 3, 6, 9-month rolling FX hedge. And that is the exact reason why an inverted curve in the West and a steep curve in Japan means that the net interest rate or the running yield carry on a US Treasury or a Bund is in extreme negative territory seen from a Japanese perspective.
In Japan you end up pickup, right? That's the difference.
And that's essentially something that will only grow worse given the decision taken by Bank of Japan. So it's close territory to buy something abroad. But they do not repatriate fixed income flows to any major extent either. The reason being that Bank of Japan is still crowding out investments in local bonds. So they cannot repatriate flows to any large extent. I had a look at Bank of Japan purchase volumes through 23 so far relative to net issuance of local JGBs. And just to take the most extreme example, in January, Bank of Japan bought roughly 15 trillion. I'm almost getting blindfolded when I watch a chart like this. I have it right in front of me here. 15 trillion Japanese yen worth of government bonds through January relative to, say, a tenth of that in net issuance. Now, in June, July, they're probably buying roughly the same as the net issuance of JGBs, roughly, meaning that you can still not gain market shares as a local life and pension fund because the Bank of Japan buys at least what it's entitled to, so to speak. That means that you cannot repatriate a lot of flows. And therefore, you don't get that positive flow into Japanese yens. But at the same time, Bank of Japan keeps printing. And the Federal Reserve is not printing. The European Central Bank is not printing, rather the contrary, right? So they debase the Japanese yen versus peers, even in a scenario where they allow the yield curve to steepen a bit.
But I think you must acknowledge that the predicament that they're in, there aren't any easy policy changes you can adopt here. You must accept some level of trade-offs. I mean, and I think in the grand scheme of things, this is not a bad move from them. I actually think it's rather smart, and they did it unanticipatedly. I mean, markets were sort of back and forth about it, but yet they caught everyone by surprise, right? Even us. It grieves me to say, but for financial markets, it's not really it's not the end of the world. As of yet.
No. Certainly not.
No.
There was a bit of speculation ahead of this decision, Mikkel, whether Japanese politics could impact this decision from Bank of Japan. I think it was a little more than a month ago we had the first story out suggesting that we could be faced with snap elections in Japan towards the end of the year. We haven't gotten the confirmation yet. So anything from the Japanese political side that is worth mentioning in regards to this?
The interesting thing here is whether this becomes a true political issue, because this has been a sort of a fixed strategy for many years. It hasn't really been a political issue. It might be now, and it might be sort of an indicator of more societal changes in Japan. So we're still waiting for that. As of now, no elections are called. So the political landscape around this is still relatively stable, but it's going to be really interesting to follow.
Indeed, Mikkel. And getting to Western soil, Emil.
Yeah.
It goes without saying that this decision from Bank of Japan impacts global bond markets.
Yeah.
Mainly via the channel of low appetite or low incentives to buy foreign fixed income for Japanese life and pension funds. Yeah. And over the past week, we've had the release of the quarterly refunding report from the US Treasury. And it is relatively evident that they are now forced to increase the duration profile of their issuance.
Yeah.
They are running close to the sort of self-imposed cap of 20% of the outstanding debt being issued in bills, meaning that they now have to issue coupons. What do you make of this duration profile, given the decision from Bank of Japan, given market positioning, etc.? Is this the perfect storm for a steepener, basically?
Yeah. Well, I wrote a piece last week, and I said that, and that was in the wake of the Bank of Japan decision, that the only thing that I was really confident about coming into this week was we would see a steepener in the US yield curve, and here we are. That's basically the only thing that has written in financial markets. I think when you're treasurer in the US, you sort of have a responsibility to. You can't really speculate in changing the duration profile.
Not too much, at least.
No, because then you fuel volatility, right? And that ends up being a loose horse you don't want to try to catch up again. So I think it was. I'm not particularly surprised that we saw additional coupons, because the fiscal landscape in the US is as it is, and I'm not the only one who's a bit skeptical on the trajectory and the sustainability, not to mention of the current fiscal regime. So I think all in all, it's pain on the long end, and probably in certain areas of risk assets as well. That's my main takeaway.
And a few highlights from that quarterly refunding report, Emil. The US Treasury now intend on increasing the cash balance to 750 billion towards the end of the year. So this is the pool of cash that they hold idle at the Federal Reserve as sort of a war chest in case of emergency. That is a couple of 100 billion more than the current TGA level, meaning that they will have to withdraw a couple hundred of billions from the private sector before New Year's. The interesting thing here is that when they increase the duration profile of the Treasury issuance alongside this target of 750 billion worth of excess cash, they cannot no longer rely on the so-called overnight reverse repo facility to counter the liquidity effects. The overnight reverse repo facility is a facility at the Federal Reserve, and it is designed to be able to take in excess cash from, for example, money market funds not being able to find eligible bills to buy. And therefore, during, say, the past 4 or 5 weeks here, the load of issuance in bills has basically just been absorbed by this overnight reverse repo facility as money market funds withdrew money from the facility to buy bills. Now that they issue coupons, the money market funds can no longer, within their mandate, buy them. And therefore, you don't get that same cushion from the overnight reverse repo facility from a liquidity perspective. I think that's potentially a game changer for risk assets. At least it is on the margin more negative from a liquidity perspective than one we've seen over the past month here.
Short term,
So interesting developments in the U.S. Treasury space. And am I allowed to say that we double down on our steepener case here?
Yeah.
I think we get increasing confirmation that the steepening case is now on. And in relation to that, and I want to pick your brain, both your brain, Emil, and your brain, Mikkel, around this topic. We've seen a downgrading of the U.S. credit rating from Fitch this week, one of the credit rating agencies. A bit more than a decade after the S&P downgraded the U.S. Was it in 2011, right? Mikkel, first of all, is this something that's on the radar politically in the U.S., this downgrade? No. They couldn't care less?
No. It used to be. It used to be some kind of symbol. You say, oh, this is embarrassing for the administration, but I was like, it doesn't really affect the lives of ordinary people from a day-to-day basis. There are a lot bigger fishes to fry, both for the president and the aspiring president. So no, this is. The era of it's the economy stupid is definitely over. Yeah. The coming elections are going to be in about everything but the economy, basically. So this is not going to be a political issue as far as I see it.
No.
Emil, a downgrade of the U.S. sovereign credit rating. Yeah. Does it make sense at all? Yes or no?
Well, yes, but I think there's a lot of people in financial markets who got a bit because obviously it doesn't affect market pricing. U.S. Treasuries are still the go-to safe haven in case the S hits the fan. But I think I think if you zoom a bit out, I think it makes sense. You can't just be, if you are a credit rater, just be completely indifferent to declining fiscal sustainability and what have you. So no, I'm not particularly surprised. And I actually, back in, I think it was before summer, when France received the exact same medicine, I questioned whether why don't we see that in the US? And here we are. And I on another note, it's really interesting about this cycle that it's the developed markets who keep getting slammed by the rating agencies, while it's actually emerging markets who get upgraded. That's as an emerging markets guy, I can tell you that's not the usual thing you see come around. But here we are.
It's certainly not. Mikkel, when we look at this decision taken by the Fitch agency to downgrade U.S. debt, they cite the political risk as the main reason to do so, and they refer obviously to the ongoing political soap opera every single time they have to raise the debt ceiling. So, I'm a markets guy, not an economist actually, and judging from sort of the surface of this issue, I simply cannot imagine a true default scenario for the U.S. Treasury. They are in charge of printing their own currency. They still have the status of being able to issue the reserve currency of the world. So the only way the U.S. can default is if politicians want it to happen.
Yes. Yeah.
And is that even a feasible scenario that we can get a majority in Congress allowing it to happen?
No. And I think the logic is a little bit reverse here, because what would happen with the U.S. government debt if you didn't have a debt ceiling, if you didn't have these debates? They're obviously a big stress factor both for the political and the economic sphere. But if you had no limits on borrowing, they would just keep borrowing. So I think it's the logic is a little bit reversed there. You're never going to have a majority for defaulting outright, because there's so much is still dependent on the federal budget. But you will see ongoing discussions on what should the role of government be, which is essentially what especially the Republicans are pushing. And you're going to see more of that in the future, and more of a debate between what's going to be the federal side of things, what are the states going to run. I think that's where the debate is going to be very much. We would have that very same debate in Europe if the EU issued debt.
Yeah. Absolutely, absolutely. They actually do, but to such a small extent that we don't care yet.
Yeah.
But I can guarantee you, sending live to you here from Copenhagen, that we will we will be on the streets if that happens. We miss the UK in the European Union in that regard. So we had someone to cooperate with on these topics. Joking aside here. I think it's very, very interesting, Emil, with this steepening of the yield curve in the US, based on the decision from Bank of Japan, based on the new duration profile from the US Treasury, that I think we should have a discussion on high beta assets in that regards. And with high beta assets, I mean crypto, I mean tech stocks, and the likes. So we saw towards the end of the week here, a clear spillover from that steepening of the curve to, for example, NASDAQ. So high long-term interest rates means a harder punishment from discounting rates, etc. So what do you make of the positioning in both crypto, tech, and high beta assets at this juncture, given the discussion on the yield curve here?
Well, I think they're a bit in peril. I don't particularly like high beta assets at this moment in time. I think we are closely, surely stepping into a regime with more volatility, and you have basically only headwinds from here, from a structural basis. That's how I see it, and that's partially why we swift to the boomer trade, right? That's one of the reasons, at least. So no, I wouldn't. I don't like risk assets at this juncture at all. I think it gets me nervy even to talk about it. But that's where I'm stand.
So I mean, these assets are typically very correlated to liquidity and long-term discount rates. So obviously it's one to watch. And I watched a clip on Twitter this week from what you probably label a Bitcoin maximalist. A guy supportive of Bitcoin, but not the rest of the crypto space. And this Indian Bitcoin maximalist, he is fucking next level. Pardon my French here. So let's listen to this guy from Twitter and get back to the discussion.
Fuck crypto. You don't need the anxiety. Before you bought the bullshit fantasy coin, your life was good. But then you made some money and became greedy. Now the bullshit coin is fucked. And nobody can tell you when it is going to be unfucked. Even the motherfucker who convinced you to buy the bullshit coin, who told you that it is going to be the next big thing, that motherfucker is nowhere to be found. You are on your own. And all you can do is cry about it in the shower. And hope and believe that your bullshit coin will go up in price again, so that you can sell it and make some money and buy some more and then get fucked all over again. That is crypto.
This guy is simply next level. But to be honest, he's spot on.
He's completely spot on.
And this is obviously during a week where Sam Bankman-Fried apparently created a shitcoin from his house arrest and managed to cheat a lot of people again. I haven't looked into the details of that case, to be honest, but
it's hilarious.
Is there a distinction between shitcoins and bullshit coins that he's talking about?
It'd be interesting to know. I don't think so. Or at least I pull them out in the same. But And we've all known in 2020. I mean, I don't know about you guys, but I've know, like, you know, you meet some distant relatives who has a son and he has a friend or something, and he's made a fortune on speculating stuff he hasn't got a clue about. And now everything is just reversed. It's back at McDonald's.
You don't hear from them a lot.
No.
But on a more serious note, right? This guy is obviously a Bitcoin maximalist. I think that's the right label. I think there's a bit of merit to that view.
I agree.
And I personally look at Bitcoin as a high beta asset from a macro perspective. I mean, if you look at empirical correlations, it's pretty neatly tied to what's ongoing in Nasdaq,
Basically,
just with a higher beta.
Yeah.
So, I mean, if I'm all in on risk, I tend to like Bitcoin as an asset class.
Yeah.
And that's how I view it from a macro perspective. I don't think it's much more tricky than that. I mean,
yeah, but also it has some institutional backing,
of course,
unlike the rest of it.
Yeah.
Right? So yeah, I've traded it a couple of times as well. So yeah.
And now we're moving on to something very, very, very different, Mikkel.
Absolutely.
Because we are moving our focus to Africa, probably a continent that we talk too little about in this podcast. But we've had a coup in the country Niger.
Yeah.
Over the it was last week, right?
Yeah.
And right now, we're kind of stuck waiting on the response to quite clear calls from both the West African Economic Forum,
ECOWAS,
Economic Community of West African States, governed by Nigeria, basically.
Yeah.
So let's listen to a soundbite from the meeting in ECOWAS with sort of what they're calling for in Niger.
In the event the authorities' demands are not met within 1 week, take all measures necessary to restore constitutional order in the Republic of Niger. Such measures may include the use of force.
Niger is the right pronunciation. I said Niger. No, never mind. Mikkel, let's try and understand the backdrop here. A coup in Niger, big country more or less in the middle of Africa, just north of the rainforest. And Mikkel, is this another proxy Russian Western conflict, or what is it?
Yes, it is essentially. I mean, Niger was one of the last countries in this region not to be completely infiltrated by the Wagner Group. And so this is widely seen as a part of the ongoing French-Russian rivalry in this region, which sounds a bit odd if you look at a map. Why would France and Russia, two globally declining powers, be the main forces in the region? But for historical reasons, they are. And Russia is very active. They held an African summit last week as well, or the week before. And Russia is very active, have a lot of mercenaries in the neighboring countries to Niger. So Niger was sort of the last democratic stronghold here. Why is this interesting? I mean, first of all, Niger isn't an economic powerhouse, so it's not like they're going to influence world markets or any certain commodity. But first of all, they're a part of the route towards Europe. So they are a close companion to the EU or cooperation partner to the EU on migration. They take back a lot of migrants who end up in Libya, where no one knows what's happening. So that's one factor. If Niger is now ruled by a Russian puppet regime, they might open up the floodgates, basically, for immigrants, which is a very big issue for Europe if that happens politically as well. Second of all, obviously, as you mentioned, it's a part of this ongoing rivalry in the region between the Russian-backed states who are employing Wagner mostly, and the French supportive states. I mentioned when we talked about the Prigozhin coup that the failed Prigozhin coup was really bad news for ISIS. Yeah. This is also really bad news for ISIS if they have any aspirations in Niger, because Wagner is going to get involved in Niger finally, and they're going to have a much tougher stance on ISIS than French mercenaries or French soldiers. So this is extremely interesting. It's called a rift. It caused a rift in the ECOWAS, where basically all of the coast countries are backing the line that we just heard from Tinubu, the Nigerian president, and the Sahel countries, Mali, Burkina Faso, are taking a stance against this. We're not going to see a war. None of these countries have any power or any opportunities or any desire to get involved in invading Niger. So this is maneuvering to show support in the hope that there are still elements of the Nigerian power base in the society that still support President Bazoum, who was toppled. I find that very hard to believe. I think the colonels who toppled him would have a very clear backing from key partners, essentially overseas, and that's going to be it. And it's a strategic issue for the West and potentially a very real issue for Europe.
Yeah. And timing-wise, it's pretty interesting ahead of what has been labeled as peace talks in Jeddah between Ukraine and Russia. But Mikkel, let's just point out the facts here. Russia will not even be present in Jeddah.
No. I mean, it was being posted all around the net. Now the peace talks are coming, and we're going to have a peace. I mean, it's not much of a peace talk if only the one side is there. I mean, that's not even at the end of World War II. Even then, you had both sides there. So this is a continuation of the Copenhagen meeting that took place a few kilometers from here a couple of months ago, and it's basically a Western attempt to both set the frame for upcoming peace negotiations and to muster an alliance of global South countries behind Ukraine.
Brazil, for example.
Brazil, India, Mexico, Saudi Arabia, etc. So that's the main effort. It's possible that China will have some observance, whether disclosed or not, and there will be some discussions with Saudi Arabia as intermediary. But these are not peace talks, and we're not anywhere close to either a ceasefire or peace in Ukraine. Sadly,
no. I tend to agree, and great that you clarified this for the audience. I think a lot of misreporting was seen on this topic. Emil, on the topic of China, you mentioned that they could decide to, at least behind the curtains, participate in this Jeddah conference. We've seen Chinese moves towards a so-called steel cap over the past 10 days here, Emil, alongside continued pump and dump rhetoric in the state media, but no action. Yeah. So what do you make of the Chinese political picture right now and the prospects for this fiscal package that everyone hopes for?
So if you take the last part first, I think the fact that they put in a steel cap whilst also pumping rhetoric about we're going to do a fiscal stimulus and whatnot. It's sort of an acknowledgement that they know that the construction investment usual trade book is basically pathological. Yeah. And they don't want to boost the real estate bubble or the bridges to nowhere tendency, which they tend to. But on the other hand, they also have the credit problems domestically, which they sort of have to attend to, and usually they get that's how the local governments in China usually get their funding, and they're at least locally deeply indebted. So that's sort of the balancing act that they're embarking on. But I think on behind the curtains, and this is difficult to really extract anything anything concrete from, but we've seen a foreign minister who's gone, and then he got fired after a month, right? And you see a new governor of People's Bank of China, and I would wager that there is a large, perhaps more or less silent group in the Communist Party with roots in Shanghai who are really dissatisfied with the current trajectory. They want to see action on the manufacturing front, and that's sort of what's going on. I think at least that's what I can gather. Perhaps you guys have something to add to it.
No, just a long-term opinion here. It's really tricky for government to decide how much steel you need. I mean, it brings back tastes of Chinese or Soviet 5-year plans. I mean, it's the wet dream of any political scientist to be able to sit around the table and plan. Okay, we need this amount of steel for the coming 5 years. But that's one of the main reasons why the Soviet Union couldn't keep up, because it's simply impossible to forecast just how much steel you need over the coming 5 years. So it's a very, very tricky course, this.
Yeah, even if you go back to the 30s, it was actually something that the Germans did, right?
Yeah,
absolutely. Hitler was actually really managing steel imports from...
Exactly. It doesn't really work long term.
No,
it does not.
It's just too hard.
Yeah.
Let's not go down that rabbit hole. But if we look at the commodity space, Emil, we've openly taken a bet on the broad BCom index, so the Bloomberg Broad Commodity Index. Yeah. We've entered longs in the XLE, so the broad energy space in US equities. We've entered longs in the material space in the US. it's not been the best week for that opinion. It could have been worse being long
Everything
shitcoins,
else. Yeah.
tech, and everything else.
Yeah.
So on a relative scale, fair enough.
Yeah.
It's still in green territory for us. But I mean, what do you make of the broad commodity space at this juncture? Is the true risk that China does not deliver?
Yes, that's a trap.
Yeah.
That's definitely a trap for broad commodity pricing, no doubt about it. But on the other hand, I think the Chinese elite is somewhat aware that they're basically undermining their own credibility here. So I think they will have to produce something of note, and that's why markets have responded the way they have. I also think that the divergence in the cyclical front and in the manufacturing sector across different regions is sort of fueling some uncertainty in the rebound, if you like, that we are currently riding. I think it's super obvious that it's the US who's primarily beating expectations here, and in Europe it's a bit more. Switzerland looks really to be troubled. On the other hand, you see Sweden surprising a bit. So it's a weird juncture, this. So that's sort of how I look at it.
Yeah, Sweden's service PMI rebounded from roughly 46 to 52 in 1 month. Either Sweden has posted a tremendous comeback, or else Swedbank, the survey responsible bank here, needs to figure out what's wrong with this crap survey.
Yeah.
It's either or, and I'm not sure yet.
No, and I learned it through you while I was on a plane. I nearly fell off my seat.
I mean, we've seen similar issues with, for example, the Danish or the Norwegian PMI, because the sample group is so small.
Yeah.
I mean, we essentially don't have more than 10 or 20 companies making enough money to be surveyed and stuff like this. So, so take it with a grain of salt, if not a truckload of salt. This number from Sweden so far.
Yeah.
I think those were the words for this edition of the Macro Sunday podcast. It's safe to say that we have plenty of things to discuss each week in this independent macro and geopolitics podcast. Mikkel Rosenvold, a great pleasure to see you.
Yeah, thanks a lot. Just a quick note for those of you listening through the podcast. We're now live on YouTube as well.
Yes.
So if you're interested in watching three Scandinavian guys in a sauna-like studio, as we hear a lot, you can watch us in there.
Yeah. 3 obese Scandinavian guys. Let's put it like that, more or less.
Directly for Pornhub.
Sure. We will not label it that.
That's the next time.
But in any case, we'll be back next Sunday with a tremendous guest, Bob Elliott, former co-CIO of the Bridgewater hedge fund. In my opinion, one of the best macro strategy guys out there, and he will be joining us for a discussion on what to do if the U.S. Yield curve continues its steepening, as we've seen here over the past couple of days. Remember that this is an appetizer to the load of material that we produce at Steno Research, both within the geopolitical field from your team, Mikkel Rosenvold, and within finance, macro strategy, etc., with you, Emil, in charge of that team. Remember that we have an exclusive offer. If you want to just join the club at stenoresearch.com, you can use Macro30, so Macro30, to get 30% off your subscription at stenoresearch.com. We will leave the link to the subscription page in the show notes. Emil, Mikkel, great to see you. And we'll see you again next week in the Macro Sunday podcast.